Financial statements to cash flows. In this video we're going to look at the balance sheet and the income statement and the cash flow statement, and then from the cash flow statement we're going to derive the free cash flow. So if you have to make a valuation of a project or of a firm, you make estimates of the balance sheet and the income statement. Based on that you derive the cash flow statement, and given the cash flow statement you can determine the free cash flow. Let's have a look. How does this work? We have an income statement over the years 2018 to 2020, and we have the balance sheet at the end of each year. The income statement, let's have a look. Let's focus on the year 2019, okay? We have revenues of 250, cost of goods sold 75, so gross profit is 175. Then there are other costs, cost of personnel, other expenses, depreciation. Operating income is 44, so that is the gross margin minus these costs. Then you get the 44. Financial income 0, financial cost 15. So the total income before tax in 2019 is 44 minus 15 is 29. Then we pay tax 8, so the net income is 21. 29 minus 8. The balance sheet shows us the assets, of course, on the debit side, and the equity and liabilities. We fixed assets 225. This is the book value at the end of 2019. The inventories 75, accounts receivable 50, cash 10. So the total book value of the assets is 360, equity 54, long-term debt, short-term debt, payables, and the sum is of course equal to the sum on the debit side. And redemption, long-term debt, during 2019 was 44. Now here on the right hand side we have the statement of cash flow. So what we do now is we try to fill in the cash flow statement, and if we have done that successfully we're going to derive the free cash flow. So the first item we're going to determine is the operating or operational cash flow. The operational cash flow is equal to operating income, which was 44, and then we make a correction for non-cash costs. A depreciation is, as we know, a cost. It shows us the decrease in value of the book value of the assets. It lowers the result, but it's not a cash outflow. So since we're interested in the operating cash flow, we have to add back depreciation. Yeah, operating income is revenues minus costs, and depreciation costs are included in the costs. So we add back depreciation to find the operating cash flow. Depreciation is 56. If you look in the income statement, you find over here depreciation to be 56. So if we add back 56, we get the operational cash flow, operating cash flow of 100. The investment in working capital, we have to look at the change in the items. Inventory, accounts receivable, and accounts payable. So if we do that, then we look at the inventories. We go from 66 to 75. So we invest during the year 9. That's an outflow. Accounts receivable went up from receivables from 44 to 50. So we invest another 6 in receivables. Accounts payable went up from 30 to 34, so that's an inflow of 4. And the sum is minus 11, that is an investment in working capital. Then cash used in financing activities, redemption, we paid 44 to the banker. Financial expenses, interest 15, tax 8, so from the perspective of the firm it's an outflow. The dividend, that's not given, but we can derive it. If you look at the balance sheet and the income statement, then we observe that equity went up from 40 to 54, while the income in 2019 was 29. So we remember that equity goes up with the net profit. So if the equity at the end of 2018 was 40, and if the profit, the net income, the net profit is 21, so not 29, 21, you have to look at the net income, 21, then equity should be 61. 40 plus 21 is 61, but equity is not 61, it's 54. So the firm paid a dividend of 7. Yeah, so the dividend is 7 minus 7. Cash used in financing activities then is 74 negative. Capital investment, we look at the fixed assets. There's an increase from 198 to 225. So maybe you say, that's an investment of 27. Yeah, almost correct, because we did not do anything then with depreciation yet. You have to add back depreciation. Yeah, if you would not invest in fixed assets, then the book value of the fixed assets would be 198 minus 56. But that outcome is not presented here in the balance sheet. The outcome would have been 142 if you would not have invested. Yeah, but we have invested. The total value is 225. So the difference is what we invested in fixed assets. Yeah, so 225 minus 142 is 83. Yeah, you can also say that is the difference between the 225 and the 198 plus depreciation. Then you also get the investment in the assets. Long-term debt, cash flow from financing activities. Did we go to the bank? Did we borrow an additional amount? The total long-term debt was 198. At the end of 2019, 227. So you say probably, then we borrowed 29. No, because you paid back during the year 44. So it works a little bit the same as with depreciation. The total amount you borrowed is the difference plus the redemption. Yeah. So the total amount you borrowed during the year was 73 and short-term debt increased by 5. So the total amount raised is 78. Yeah, 78. Now the sum of all these items we calculated. The sum of the operating cash flow, the investment in working capital, cash used in financing activities, capital investments and cash flow from financing activities should give the change in the amount of cash. So cash went up indeed from 2018 to 2019 from 0 to 10. And that's what we see here. That's what we see here. And from 2019 to 2020, cash increased by 3. That's what we observe over there. Yeah. So if you do the valuation of a firm, you have to construct estimates of the income statement, the balance sheet, and also of the statement of cash flow. And you can always check whether you did it correct, because the sum of all items in the cash flow statement should give the change in the amount of cash. Now, what's the free cash flow? If you need a free cash flow, then you look at the items, operating cash flow, investment in working capital, capital investments, and you deduct the corporate tax as if the firm has no debt. So the operating cash flow in the previous example, 2019, was 100. The investment in working capital was 11. Capital investments, 83. And the tax paid as if there's no debt. So then you multiply the marginal tax rate with the earnings before you deduct the interest expense. And then you get an amount, if the marginal rate is around 27%, then you get an amount of 12. And then if you add all items, we have a free cash flow, which is negative. It's 6. Yeah, so not an inflow, but an outflow. Free cash flow negative. Why do we not deduct the tax that you observe in the income statement? But why do we determine the tax as if the firm has no debt? That is because you take into account this tax advantage you have. If you finance your firm's assets partly with debt, you adjust the discount rate for that, the weighted average cost of capital. We will discuss this later, but that is the reason. Yeah, so the free cash flow is operating cash flow minus the investment you need to do to run the business. So you invest in working capital, and there are also other investments to be done. And of course, you have to pay taxes. So that are the numbers for 2019, and here you find the numbers for 2020. Although the firm realizes a net profit, I go back here, you see it, net profit of 21 and 18 in 2019, 2020, then the free cash flow is negative. Yeah, And that's because, yeah, we invest a lot. Yeah, probably that is one of the reasons over here. Okay, that's it. Thank you for your attention.